Welcome back, ladies and gentlemen, and I'm continuing with ETBFSI Digital Conclave. This is going to be a very interesting session because we are going to talk about buy now, pay later, which is a product. It's been really booming in the digital lending space. And let me tell you, I have four speakers which are actually leading these initiatives at their companies, and they will share great insights on this topic. So, ladies and gentlemen, allow me to introduce them to you first. So my first speaker for this panel discussion is Mr. Bipin Singh, co-founder and MD and CEO of MobiKwik. Bipin, glad to have you.
Glad to be here.
Thank you, Bipin. My next speaker is Sashank Rishyasringa, co-founder and MD Capital Float. Sashank, glad to have you.
Likewise, Amol. Thanks for having me.
Thank you. My next speaker is Mr. Krishnan Vishwanathan, founder and CEO of Kissht. Krishnan, glad to have you.
My pleasure. Happy to be here and be part of the panel.
Thank you, Krishnan. And my next speaker is Mr. Prashanth Ranganathan, the CEO of PayU Finance. Prashanth, glad to have you.
Well, thanks for having me, and fellow panelists, hello, and looking forward to chat.
Thank you. Thank you. So, gentlemen, we have been hearing a lot about BNPL. When it started, there were a lot of ambiguities whether the product will pick up or not. But now, as I exchanged some notes before we started, that even the banks have started reporting BNPL segment in their quarterly results, which simply means that the product has made its impression in the market and there is a huge demand for it. So to begin with, I have a very basic and a common question to all of you, and I will go one by one. So Bipin, I will come to you first, and I want you to answer. What are the reasons behind the success of buy now, pay later?
Sure. So Amol, so India is a very large population and a very large growing digitally savvy population now. Almost 500 million people have smartphones, and almost 250, 300 million people do digital transactions. But if you see the penetration of credit in our country, especially unsecured credit, it is amongst the lowest in the world. And even the credit bureaus have maybe around 150, 200 million good quality data. But beyond that, effectively, Indians do not have access to credit. There is only about 40 million people who have credit cards, right? Which is less than 3% of the population. So I think the opportunity here is that obviously people who can afford to use smartphones and who can shop online, order stuff on Amazon, or order food on Zomato or Swiggy, and can buy clothes, electronics, different kind of things. They obviously, from an income point of view and a understanding point of view, they can get access to credit. And buy now, pay later is simply, I would say, the easiest way for users to get started on that journey in a country like India, because the fact that there may not be enough of a credit score or a rich credit score gets balanced by the fact that there is enough data about their transactions, about different kind of data points, what kind of smartphone they are using, and all these data points can be used to understand the customer better and offer them flexible, low value limits at a low customer acquisition cost, which is something that the more traditional banks will find it challenging to do, have found it challenging to do, because of the fact that there is higher customer acquisition cost, there is cost of distribution, and there is cost of operations on a card, for example, which means that making money on a 2,000 rupees credit line or a 5,000 rupees credit line is impossible for a bank. So therefore, you find that India is a perfect country for buy now, pay later, where essentially it's a payment product where you're paying for things, but you have a credit attached to it. So you can use it and you can repay it and you can build your credit behavior, and then slowly you can get a credit card, or you can get a personal loan and get into higher ticket kind of purchases. So I think that's the reason why in India, especially, I think it makes a lot of sense. Actually, it makes much more sense in India compared to the developed countries from where we have sort of, gotten inspired because of the reasons I mentioned.
Okay. Sure, Vipin. I think you highlighted many relevant points here. So let me move ahead and take Krishnan's perspective. Krishnan, you're operating in this space really long, so I'm sure you may have a different perspective than what Bipin said, adding to that. So could you please go ahead?
No, I don't think I have a different perspective. In fact, I would say I would echo a lot of the things that Bipin Preet said. I think the fundamental gap in the opportunity is well laid out by Bipin, right? 300 million smartphone users, 500 million potential credit users against 40 million credit cards. I mean, I need not say more where the opportunity is coming from. I think overlaying that with the fact that, even where the credit is being made available, it's being done, with a very affluent segment in mind, right? Or if not an affluent, a mass affluent segment in mind. When you think about a credit card, you don't think about a line which is less than 50,000 or less, right? I mean, that's the kind of credit lines you get even in the most basic of credit cards. But in India, it is, I mean, bottom of the pyramid is a cliche term, but the mass market and the lower mass market is where the real opportunity and where the real gap is. So when you come to this segment now, you're not only talking about the basic fundamental product is not available, but the kind of lines and limits that these guys need, which is anywhere from say 3,000 at the lower end to 15,000 or 20,000, simply does not exist, right? And does not exist for a very good reason. You need to think about credit in a very different way. You need to think about acquisition in a different way. The operating model has to be super lean for it to be value creating. Therefore, this is where I think unless you completely re-architect your operating model, which at least the larger traditional banks have struggled thus far, but some of them are making good headway. This is where I think the opportunity is there. So, it's a real gap versus need, but the need backed by a set of consumers who are really clamoring for this product, right? There is a convenience and a credit proposition both baked into one. And so the demand is fantastic.
Valid points, Krishnan. I think meaningful thoughts here from both of you. Let me move ahead and bring Sashank here. Sashank.
Thanks, Amol. So yeah, I think to start off with, I would absolutely echo the points made by Bipin and Krishnan, right? I think they've perfectly summarized what has made India a very fertile ground for BNPL. And so I'll attempt to try and add some value beyond what they've said with 2 points. I think firstly, what's significant about what's happened in India over the last 2 to 3 years is that the structure of commerce has started to change quite dramatically, right? And it really began with Geo and has accelerated through COVID to the point where we could actually imagine a future where customers prefer to buy things online than offline, right? And I think it's worth noting that for all the progress of e-commerce in the US, e-commerce and even Amazon is still a very small fraction of the overall retail market. And I think given the access play in India, around tier 2, tier 3 cities and the huge underpenetration of brick and mortar retail, we could actually see e-commerce become the default rather than a diversification point in retail. And I think that's extremely fundamental. And we've seen that in other emerging markets as well, right? Like China and Indonesia and elsewhere. And I think the reality is, we are all first derivatives on the real economy, right? And finance follows commerce. And with the structure of commerce changing so dramatically, it was just a matter of time before the structure of finance has to follow. And I think more than anything else, BNPL is a credit and payments product reimagined for the world of e-commerce. And in that sense, you are seeing customers who are actually entering the formal economy through e-commerce rather than physical retail, and hence entering the financial ladder through BNPL as opposed to any other traditional instrument. I think the second important point is in India, at least, right? I think BNPL at the end of the day is proving to be more a credit product than a payments product. In the West, a lot of BNPL players, the game has begun and ended with payments. And where they have looked to extend it, you have seen players go into, for example, trying to become shopping engines and things like that, right? Everything you've heard today from the panel talks about BNPL as an entry point into the life of the next 100 million consumers. You start with bite-sized ticket sizes, grow those as you see repayment behavior, and ultimately look to cross-sell and upsell larger ticket products and become a one-stop shop financial partner to your customers, right? So I think just as we see a lifetime value credit play through BNPL, customers see this as a start of a credit relationship that can really scale with time. And I think that creates a degree of stickiness in the product that is likely to outlast what you see in a lot of more mature economies where BNPL is more the latest payment fad as opposed to something that's fundamentally altering the lives of its customers.
Again, detailed points, Shashank, from your end as well. Now, let me bring Prashanth here. Prashanth would like to have your perspective now.
Man, it's always great to go fourth when three other panelists know exactly what they're talking about. So I'll try to add some sense here. So first of all, I think, look, I'll underscore something Bipin said. Like BNPL in India has always existed in different formats, right? So whether it was a credit card payment and then you had like 30 days or 45 days to pay it back, or then EMI on debit, which came later, which is also an avatar of BNPL, or the famous like Bajaj EMI, right? Like that is, I think, the primary vehicle. It wasn't called BNPL, but I think that was the primary vehicle and long-standing in the country. I think what has happened over the last 3 years, I think like others have mentioned, is that the BNPL format has just become more pronounced. And I think that is one part because of the boom in the digital e-tail kind of economy, and one part because of the form factor of the instrument itself. So let me just talk about like why we think BNPL has grown for us, right? So firstly, I think it's a lot easier to offer a BNPL product to a consumer that is new to credit or is thin file on the bureau. It's because, well, you're only underwriting them point in time for a specific purchase. So the end use is known and it's only a single use credit product, if you may. So your exposure and everything around it is well grounded. So unlike a credit card, which is open-ended, or a personal loan, which has its own artifact, this is well understood as a end use that's known, and it's a point in time for a specific amount. So that makes underwriting and offering this to a very large base possible. So the second thing is on the consumer side. Often the consumer doesn't think of BNPL as credit, right? And consumers that were initially averse to credit actually gravitate towards BNPL because it's just a smarter way of kind of paying for things that they were going to pay for anyway, right? So if you take the purchase on Swiggy or Zomato or Dunzo that we do as a deferred payment product, which is also classified as BNPL, it's not that the customer doesn't have 300 rupees in their wallet. It's not that they need credit from us to enjoy that biryani, right? It's just that at that point, they choose the convenience of just decoupling the purchase from the payment. And so that gets them going. And that also sets the habituation of like, creating a contract where you owe money and then you fulfill that obligation. And then you owe money and you fulfill that obligation. And then in rinse repeat, right? And that's what I think the panelists have also picked up, that, okay, you start there, that's a great flywheel. And then you can build on other credit products over time. A lot of the times that initial 300 rupee product is not even break even, right? It actually costs you more in terms of losses and rewards and everything else. But what you make downstream from that mass kind of influx of customers is what's everyone's bet. So I think that's what's happened over the last 3 years. I think as Sashank said, it's been massively accentuated by the fact that we've just gone through a pandemic, and now it's here to stay.
Noted points, Prashanth. In fact, I wanted to ask about break-in, and you spoke about it. So let me go ahead and bring Bipin here, and let me ask maybe some specific questions in and around that. And gentlemen, if you have anything to add, please feel free to do that. So Bipin, my question is about the break-even. The volume is huge, no doubt about it, but the ticket size is very less, and I do not know whether the people operating in this space are actually making the realistic profit out of it. So let me know your story, Bipin. Are you making profit? Have you done your break-even in the BNPL space? If not, how long do you think will it take for any company or for you, to reach to a break-even level?
Sure. So, if when we look at our numbers, basically, see, we have actually filed to go public last year. And so actually numbers are all public and in the public domain, especially the BNPL segment, which we have identified as a separate segment. Nearly 20-25% of our revenue comes there. So actually it has been contribution margin positive since the time we started. And even through COVID, where obviously losses went up for everybody, including ourselves, it has actually maintained to be contribution margin positive. So yeah, I mean, it is a profitable business, and we've actually not lost money on BNPL till date, right? But I would say that we're still in the very early phase of actually making realistically a lot of money out of it, because I think the journey of customer entering into the funnel, where they start with a small ticket and get used to the product, get used to repayments, and understanding risk, which is obviously a critical part of the entire profitability, that has takes its own time. So in my view, the model itself has a, if you look at credit card equivalent, right? Every single credit card company makes a lot of money, right? If you see the top 4 or 5 credit card issuers in India, they make truckloads of profit. So BNPL as a segment, if done right, in my view, and that's a big if, obviously, with proper low customer acquisition cost, with low or manageable cost of risk, and appropriate downstream cross sell, which means you're able to do higher ticket as well, right? Not just a lower ticket. That will surely result in profit. There is no doubt. It's just a, I think, matter of proper execution, in my view. And the market is very big.
Right. Yes, I mean, no doubt the market is very big, and when you go for higher ticket, there will be a big difference. So, Krishnan, let me bring you here. What kind of growth have you seen in your business? Have you started making money out of BNPL? How many loans are you disbursing every month, and what kind of growth do you see going ahead in this segment specifically for you?
So we are, so to answer your question, yes, we are making money. Our business model is slightly at variance, I would say, with some of the other panelists here. When we onboard a customer, we provide at the same time both a BNPL offering as well as a cash limit offering. So it's a concurrent offering. And just as an example, I give you a limit of 10,000. There's a sub limit within that for say 3,000 rupees, which can be for BNPL purchases. And then there's a sub limit for cash limit. So at least in our specific case, we look at a customer level value rather than a product level value. But to answer your question, BNPL, if done the right way, definitely creates value. I think what has happened globally is that the way the BNPL has come about, and it has been the way it's in India now, is seen as a free revolve product, right? Even credit card has that free revolve period of 30-45 days. But unlike a credit card where there is an interchange fee which contributes some amount of income, especially for the high transacting customer, the equivalent of that doesn't exist in the BNPL right now, right? There's no interchange. You're just directly interfacing with the customer and merchant. And therefore, unless you're able to charge the merchant, which if it is a behemoth like a Flipkart and Amazon, very difficult to do, the only way you start making money is either do a cross sell, as Bipin said, or you basically charge for the BNPL services itself, right? And at least as a company, we feel that the Indian consumers are mature enough to pay for the BNPL services, and we do charge for it, right? Therefore, I think two things to say. One, BNPL is fundamentally a very, very sound product, and consumers are willing to pay for the convenience and credit of it if done the right way. That said, it is a small ticket product. If I look at the early cohort of customers that I acquire and who's been in a system for 3-6 months, there is no way you make money out of them, right? There are risk costs associated, particularly for the segment we operate in, which is lower income segment. There are risk costs associated with that, and there is only so much, you can charge them. So at least the way we see it, it's all about customer experience delight. I will echo, I think it was Sashank or Prashanth who said, you give them a delightful experience, they will stick on with you for an extended period of time. There are people who stick on with us for like now 3 years and continue to use us actively, right? So if done the right way, that's what creates value. The life cycle value is what creates value, and there's a huge opportunity out there. To answer your question more directly, we have seen tremendous growth. We disburse about 500 crores every month. It's a combination of both BNPL and the cash loan. The BNPL is a significant part of that quantum.
Right. Okay. Noted your points, Krishnan. Prashanth, I want you to tell us more about the due diligence of the risk process. I mean, the delightful experience is very important that you said sometime back. The convenience and credit is very important, and I think that's why millennials and including Gen Zs are going for a loans which you never heard of, going on a date and they're taking a personal loan through BNPL, or so many things are happening. I mean, digital lending and so many shopping which they are doing, going for a wedding and buying a suit or dress on the BNPL product or something like that. How do you actually analyze the risk, and how accurate your risk analysis is?
Yeah, so I think that's a good question. I don't know if I could talk to it for hours, but so look, I think let's clearly demarcate like what BNPLs we're talking about. So there's a deferred payment product, right? Which is I buy something on Swiggy, I buy something on Zomato, I buy something on Dunzo. It's typically like less than a 2,000 rupee purchase. It runs on a purely pre-approval concept. We, through our data intelligence and the work we've done over the last 6 years, have kind of been successful in creating a very large 62 million pre-approved base. And to those customers, when they show up on Swiggy or Zomato or Dunzo, we want to be the preferred method of payment, right? And for that, I think I agree with Krishnan. I think if you can't create a beautiful first-time experience and a beautiful, consistent kind of ongoing experience, you eventually end up like kind of spinning out, right? So you have to, so consumers who come and use you once and leave you end up costing you more. But consumers who come and use you once and then repeat that like 4 times a week or 10 times a month and keep going, those are the consumers that ultimately A, are lower risk, and B, are much better from a portfolio standpoint, right, for their deferred payment product. Then you have customers who graduate from that stage to taking down like a 10,000 rupee, 20,000 rupee, 50,000 rupee, just on a click of a button, right? Because they've already kind of done all the compliance and the regulation and everything else, and all the checkboxes have been checked. So all they need to do is they say this big credit line, and they can pull that money directly into a bank account. They used to be able to directly utilize it from their UPI handle, and that's coming back soon. Or now on the lazy card product, they can actually use the card and with just-in-time funding, pull down that credit line. So again, it just comes down to saying, okay, look, I have a credit line. I can use it at Swiggy for 300 rupees, or I can go out and buy that suit or treat my wife or girlfriend to a nice meal and use my card. Or if it's a small tapri in the side of the street, and all they have is a UPI kind of QR code, I can just use my phone to scan that QR code and pay. So the modality of payment is just all about the convenience, but ultimately it comes down to that credit line. And that credit line, to be honest, I mean, we is one part bureau, one part BNPL performance. So the more you use, the more you perform, the more information we have on you, the better understanding we have for you. And then like one thing that has been our quote unquote secret sauce, but I can talk about at a high level, is that we use this concept of a graph, right? So we basically never underwrite anyone as a discrete individual. We look at them as a function of the ecosystem that they belong to. And even if I don't have a ton of data on you, I always have enough information about everyone connected to you and around you. And that helps us kind of make a very sound decision about how we should serve you. So that's kind of like been our approach. And everything is self-reinforcing, right? Every time someone borrows from us and pays us back or doesn't pay us back, we learn something. And not only do we learn about that person, but we learn from a network standpoint. So we have an exponential learning curve that basically kicks in at that point. And that's, to be honest, like how it all gets reinforced.
Okay, meaningful one, Prashanth. Let me take one more question to all of you. Again, it's a common question. The question comes from my recent interaction with someone called T.S. Anil, who's heading the Europe's challenger bank called Monzo Bank. And he has been doing a lot of disruption. And I asked him, why do you, tell me something about disruptions. This is the one thing which I keep telling myself, is that there is a reason why this place was not disrupted till now. And when I see, all the fintech players and the big companies like you are disrupting the BNPL space, the question that comes to my mind is, one, is it the right time to disrupt this space? That is one. And second is, by any chance, disbursing is still easy. Collecting the data and finding out, who the customer is still easy. But what if the customer buys now and doesn't pay later? So what is the strategy there in place? So the question is in two parts. One is this the right time? And second is, what if the customer doesn't pay later? And I will start with you, Bipin.
Yeah, so valid question. I think, the business of lending is the business of risk management, right? Ultimately, you have to take a risk, because if you want to have zero losses, then you should do zero disbursals. So I think the way to think about this is how to create a portfolio over time, and how to have a sort of a risk management strategy in place which works for you as an entity. And that may differ for different people because in the overall scheme of things, there are different elements. There is cost of customer acquisition, there is cost of operation, then there is cost of risk. Risk is not the only cost, right? I think from that point of view, like I said, I think at a unit level, if this equation adds up, which means that if you can calculate a lifetime value of a customer, which is higher than the cost of acquisition and the cost of risk, and the cost of collections, which are the big three sort of costs in this business, then it works, right? The way we've solved it, at least at MobiKwik, is that we have at least one advantage, that the cost of acquisition for us is literally very low. It is zero. Because of the fact that we have a wallet which has more than 100 million customers. We've pre-approved almost 25 million of them. Based on their behavior on the payment system, we have a lot more data about them already. So it makes the cost of acquisition also lower. We also think about cost of risk in a way that ultimately a lot of these customers either are new to credit or they do not have sufficient rich score in the bureau. So there is no formal way of underwriting them except using some alternate ways to understand how much they spend, where do they spend, where do they live, what does their KYC information tell you. So based on that, you take a call and then you assign certain limits to these customers. So if you were to log into MobiKwik and take use of this MobiKwik Zip product, which is our BNPL product, then you may get a limit of 20,000 or even 30,000. But if somebody who's just out of college and doesn't have a card and just started work may get only 1,000 or 2,000 rupees. So it's not just about collecting money. It's also about, for example, limit management. How do you assign different limits to different segment of customers and have a more portfolio approach? And the other thing that I think Prashanth also mentioned and Krishnan also mentioned is that in this business, how you build the portfolio and how many customers stick to you is the ultimate way you can only make money, right? This business is not viable if you have a lot of churn, because then you have cost of acquisition and then customers will leave out. So customers have to love your product and they have to love it for whatever reason, whether it is for convenience. Some people may use it for convenience, some people may use it for credit. But if you build a portfolio of enough users who are repeating on the product, and then that's how profitability is built. If you see the credit card portfolios of all the credit card companies, right? I mean, they are profitable today, but when they started and the way it is built, right, it takes time, right? It takes 10 years, 15 years, sometimes 20 years to get to a place where you can start churning a lot of profit. So in our case, for example, we already have 80% repeat usage, and we are trying to push it to 90% people who are repeats. So I think these are some of the things to think about. And disruption and all, like you mentioned, is all very fine. But going back to the basics, what banks have done and what financial institutions have done, there is a reason why those things work, right? And so you have to stick to the basics, but the key advantage is to use technology also. I think that is one thing that I will also mention, that the advantage at least fintechs like ours have, which is a diminishing advantage with every year because banks are also catching up, is that we can use technology faster and we understand technology, so we are able to create better experience, lower cost, etc. By using technology as much as we can.
I think you highlighted really important points, Bipin. Let me bring Krishnan also here. Krishnan, please go ahead with your answer.
Thank you for that. I was just saying, I remember someone told me once that if you think this is the right time, you're probably too late. So I will just say that it's been the right time for, I would say, a few years in India, right? What has happened or transpired in the last 2 years is just, I would say, a COVID pushed acceleration of the process, which was way overdue in India. I think it was a shame, the level of credit penetration, the formal access to such products not being available for really well-meaning households in India was, I think, something that we were lacking as an economy. So it is definitely, to answer your first question, definitely the right time. It's been the right time for 3-4 years now. And I would say the impetus that has happened now is only going to increase. I know Sashank made a point that, structurally the shift towards e-commerce, e-tail, etc. But, I remember there was a project I did with McKinsey 10 years back where we were talking about how big e-commerce will be vis-a-vis organized and disorganized physical retail. It's still small, and I think 10 years later also it will be small. So when we think about BNPL, e-commerce is an obvious opportunity, but there's a far bigger opportunity to make the same product available from the tapri wala, as Prashanth said, to the restaurant. So it's, once you have a customer, that customer is not just a single channel customer. He's an omni-channel customer. He's going to go everywhere, and anywhere he transacts, I need to find a way to make embedded finance and BNPL available to make his life simple and easy, right? So what we are seeing today is a very scratch in the opportunity. The last 3-year growth will continue for the next 5 years. I think that's point number one. Point number two on Bipin said exactly, whether it's credit or BNPL, it's about the right limit, right customer, and right collections. I mean, you have to get all three elements right. And where I would say I'm slightly different from Bipin, I don't think banks know how to do collections, at least not for this product. And I would say for the products they themselves are doing as well. There is a lot of data science and technology that could make a very fundamental difference in collections. May not be the way we think about collections, at the time of trying to acquire, think about digital and technology at the time of acquisition. But even here, can you bring down the cost of collections by, 10% or 20%? Can you create an experience value within collections? Collection is an outcome of a stress situation for a customer. Can you use that same collection process using technology and the right communication tool to create a decent experience in what is otherwise a stressful situation for the customer? Makes a huge difference, and again relates back to the stickiness of even these customers. And again, I will speak for my customer segment. I'll again go back to the point that I'm making. We are catering to a lower income segment. If I stay with a customer for 1 year, I would say 80% of my customer will have some financial situation in that 1 year, and there will be some event of default that will happen maybe for 2 days, 5 days, 10 days. I cannot wish away that. What I have to solve for is how do I work with the customer to make it a good experience and make sure that I'm still containing my risk. And therefore, that focus using data and technology in the collection is equally important. We spend a lot of effort in building that competency, and it has to go hand in glove with the customer experience at the time of onboarding and use of BNPL.
Noted your points, Krishnan. I'm sure the PSP banks will look at your comment and maybe take your suggestion in terms of collections. I wish you could have advised them. The money would not have applied. You would have helped them collect the money there. Good points, Krishnan. Let me come to you, Sashank.
Yeah, Mo. So I think on taking your two questions one at a time, right? I think on the first one, I would agree with my fellow panelists. I think the opportunity in India is always growing. And as I say, it's never as good as it looks and never as bad as it looks. So I think the time to jump in is now. And I think the pandemic in the last 2 years has really accelerated things to a point where digital penetration is actually quite exciting. And we're seeing a lot of the numbers that, I think we all came here to do 5, 6, 8 years ago. I think on your point on risk, I think it's absolutely spot on, right? Because at the end of the day, this is a lending business, right? Irrespective of what people may call it globally. And in a lending business, everything comes down to risk. And there are actually two kinds of muscles around risk that I think all companies doing this have to build to scale in the long run, right? The first is really around credit risk, right? The simple point of giving money out to the consumer, how do you get it back? And I think what we've seen is there isn't a silver bullet to this, right? Of course, you have underwriting, and there's a lot of analytics and learning that needs to happen on the underwriting side to get better at screening customers, figuring out the right models at acquisition, and so on. Equally important is actually customer management, right? Given that BNPL is a line product and it's a lifetime value product, a lot of the muscles that folks in the US have really mastered, especially in the credit card space, are equally relevant here, right? How do How do you increase lines of good customers? How do you reduce lines of customers under stress? How do you ensure that on a value-weighted basis, a significant share of your GMV is actually coming from customers you have some vintage on, right? I think that is a very underappreciated part of risk management in India, because a lot of lending businesses are sort of origination treadmills. But I think BNPL gives you a unique opportunity to acquire a customer and then build a business on top of them, as others have mentioned on this panel. And being able to actually do line management well can be a superpower if exploited in the correct way. But I think a third really big piece, right, and Krishnan touched upon this, is collections. And ultimately, I think in India, collections has as much of a role to play as underwriting. And here I would slightly differ with him. I would actually say there is a lot to learn from the banks and the incumbent players, right? And I actually think fintech has probably been underweighted on collections. And we all talked a lot about underwriting in the early years. But the reality is, if you look at performance on a through cycle basis, it's the ability to collect, do that efficiently, and build a proprietary collections capability, both on the tech as well as on the people side, that at least for us has been crucial, right? And it's been a journey to get to a point where we're able to deliver NPAs of about 1% or thereabout, both on a calendar as well as on a cohort basis. But I think it's only at that level of low risk that you actually start to see the product be profitable and actually be able to build a scalable business. Because as a high volume, sort of low margin business, NPA is sort of almost in some ways our equivalent of the cost of jet fuel for the airline business, right? You have to, if you get that right, you'll make money. If you don't get that right, you can do everything to every other part of the P&L and it's not going to matter. So I think getting NPA is absolutely critical. And I think the second set of muscles around that is that there are actually set of organizational muscles around building a company that can scale and can be able to actually deliver credit at large volumes and manage the liability side of things, right? And so there again, I think we believe that there's a lot of value in being regulated. There's a lot of value in working with regulated players. And there's a set of, I think, capabilities around managing rating agencies, debt providers, being able to actually kind of manage your ALM profile, your liquidity, your CAR, being able to actually get a lot of your provisioning right. It's unsexy stuff that we don't talk a lot about in fintech. But if you actually look at any kind of lending business at scale, be it an NBFC or a bank in India or globally, these are the metrics and capabilities that kind of make or break at scale, right? And this is what really drives the ability of one platform to attract capital for lending and the other platform fails to do. So I think these are, as we all grow up as a sector and as companies, I think these are a very important set of muscles that need to be developed in parallel with underwriting and collections, which is really the heart of the business.
So Bipin, let me come to you. How are the bank and the NBFC partnerships with fintechs? Because obviously a lot of fintechs are operating in this space, are generating leads for the banks and NBFCs. Is it a new business model for the banks and NBFCs altogether?
Yeah, you can say so. I think, basically the way I think about this is that there are two kinds of players. One is a kind of player who can build a technology product, a front-facing, let's say a buy now, pay later, or a credit product, and get distribution at scale at a significantly lower cost. And the second is the kind of companies which have big balance sheets, right? Which is basically either the banks or the large NBFCs.
Right.
A lot of the large banks and NBFCs, most of the, if you go by number, most of the banks and NBFCs in this country do not do retail lending very well.
Okay.
And if you see, banks itself, right, originated in India for corporate lending.
Right.
I mean, retail lending in India is only 25, 30 years old, right? And before that, you had to go and beg in a State Bank of India branch to get a loan. So, given the sort of the opportunity in India, there is a disconnect where there is, on one side there are large balance sheets sitting, but no customers, doing more corporate stuff over the years, and the DNA being there which is do more manual stuff, underwriting, etc. So obviously it's not everybody. There's HDFC, ICICI, Axis. A lot of banks have come, but they represent less than 100 million of India's population.
Right.
Right. I mean,
Okay.
most of India's people, consumers bank with the PSU banks, or that's why there are so many NBFCs in
Right.
India, right? Because they reach out to different segments, secured and unsecured. But corporate is still very, very big. Retail is very, very small. So, which is where I think the matching happens, that it's a good partnership where on one side you get the capital, which is available maybe at a reasonable cost or a cheaper cost, and on the other side you have these customers who are in need of a product. And I think that's where the partnerships do work. And slowly but surely, almost all the banks and NBFCs are getting onto this bandwagon. I think it's just a matter of time. Banks will have their own efforts also, but I think the partnership model is going to be there for the next 10 years. I know there is a lot of talk about regulations and change in regulations, getting NBFC, etc. Those may be more procedural and regulatory, just satisfying the regulatory requirement. But just from a capital point of view, I think the partnership model is the right model. And I actually, as a fintech coming on the other side, we are not a bank or an NBFC. Our experience is that when you work with good entities, whether they're an NBFC or banks, it actually adds to your experience and learning, because you become smarter about many things, which these companies have understood. Either it's about underwriting, risk management, portfolio management, etc., at a large scale over the years, and that's always a plus, at least coming from a fintech's point of view.
Okay, sure. I think I made a small mistake. I wanted to take Prashanth's view also on the previous question which I asked, but I will repeat that. But thanks for adding that answer with it. So Prashanth, the question which I had asked earlier to all three panelists was, this is right time, and what if the customers buy now but don't pay later? I want you to answer that.
Yeah, thanks for coming back. Look, I think in terms of timing, the opportunity is so vast that someone starting today could perhaps catch up with the rest of us in 6 to 8 months, right? It's just a question of, will they have the right discipline? Will they follow the right cadence? Will they follow the right risk controlled kind of growth? Or will they choose the approach of private equity and burn till you figure it out, right? Fake it till you make it. I think in credit you just can't do that, and I think this will be perhaps a lesson for many of private equity firms who have chosen to kind of push credit companies in the country very aggressively. They will find out at some point that credit is one of those like measured kind of growths. You never have a huge benefit in terms of like growing like e-commerce or entertainment or like media or whatever, right? So you have to have a controlled, measured growth. So in terms of timing, I think the opportunity is huge. I think someone can enter now and get there. In fact, we are seeing a lot of companies that are entering now. But at the same time, there's a cohort of us, right? The 2015 cohort, as I call it. We're not sitting, and twiddling. For sure. So we're going to compete aggressively. And then you've also recognized that the banks, which is the cohorts of the 1980s, perhaps, they're not sitting and twiddling their thumbs either. So there's going to be some intense kind of competition, which is the right thing. If we all compete for the same 15, 20 million users, I think we'll find ourselves in a soup. But I think if we keep expanding the market, like the talk about the tier 2, the tier 3, what excites me most about the way we have grown is that every time Swiggy opens up a city, or Dunzo opens up a city, or Zepto opens up a city, we get to go in those markets, right? We get to see net new people who are not being approached by HDFC or an NBFC or even any of my competition. So from a timing perspective, all good. On the second, I think the panelists mentioned almost everything, I would say, except there are two types of things. One is we often as a group end up talking a lot about NPAs and reducing NPAs, so reducing bad spends. But in a portfolio approach, it's just as beneficial to the company to increase good spends, right? To create a phenomenal experience for people to kind of spend more conveniently, so that they are good repairs, so you end up capturing a lot of the good spend. If there's a lot of friction in the process, both onboarding and ongoing, and if the customer service is not sorted out well or whatever, what you end up finding is that the good people drop off, right? Because they have options. And the ones that stay are the ones that are not credit. They were on the fringe anyway. And if you just kind of keep amassing and concentrating that base, then eventually you run into like massive issues. So I think we think about just as much about increasing good spends as reducing bad spends. The one other thing that we talked about, I think Sashank touched upon this, is I think around cost of funds, right? I think NPA, yes, is such a is kind of like the jet fuel, but I think cost of funds, which is your next question, which is where the banks have an advantage, is the real jet fuel, right, for our business, because. And that's a big advantage we've enjoyed, frankly, not because of anything else, but because of the parentage of Process. We've kind of been rated as an NBFC, we're a large NBFC, and we've kind of like gotten the benefit of the parentage. And what I'm seeing now is multiple points of bottom line benefit, right? Like in terms of like the cost of funds. And now I know, I really appreciate what the banks are sitting on, right? Because they are actually deposit taking. So they have a massive advantage compared to any of us. And I'm talking about multiple points. So they actually could truly take a shift to the left and really muscle a lot of us out, because they really have that 4% cost of funds type of advantage. Now, it's a question of whether we bring down our cost of funds first, or whether they figure out all the tech and the experience and the underwriting and the monitoring and the collections first. So that's the race we're in.
Wow, that's really nice, and I think that goes with the digital strengthening, which is the theme of the UN. Let me ask one strong and a very important question to all of you, which is based on the theme of this panel, and let me borrow it from you, Prashanth. You said something very nice, that and that growing the market, reaching to tier 2 and tier 3 cities, right? That will actually help a lot of fintech players operating in this space to grow. Somehow that didn't happen. Let me give this analogy in insurance sector. In 20 years back, when IRDI or the government of India allowed private insurance companies to come into the market so that they could sell life insurance and cover, increase the penetration. Even after 2 decades, the insurance penetration of life insurance didn't increase. They were, what you can say, fighting in the same pie that the LIC has. I mean, LIC is still dominant player there, but they could not. Obviously, they improved the market to some level, but the penetration is still very low. So I think as soon as the companies go forward into tier 3 and tier 4 cities, the things will be different. But considering the cost of fund will be an issue, considering the banks and NBFCs will have an upper hand, and considering fintech companies are also going aggressive, what is the future of BNPL? And you just answered question, but I will start with this question round with Sashank. Sashank, please go ahead and tell us what will be the future of BNPL specifically.
Yeah, it's a great question, Amol, right? And I think, look, to be fair on the industry that we all operate in, I mean, there are large parts of this industry that aren't that different from what you talked about in insurance, right? You see a large number of BNPL offerings today actually going after the same 25-30 million unique credit carded base. And there's a lot of action on that front. And, those people have 2.6 cards per person, and it's probably going up with the number of new card offerings in the market. So I do think there is a distinct risk of BNPL, again, trying to take the easy way out. And so I think we all have to, in some ways, kind of keep ourselves honest. And I think, as Prashanth mentioned, the best thing to keep ourselves honest is actually the differential cost structure of fintechs versus banks, right? Because that forces us to go out and look for customers that aren't served and figure out how to actually price risk, which is a discipline that didn't really pick up in India for decades, and go out and create, the Capital One equivalent of what India needs, right? Which is to actually create lifestyle credit products for the next 100 million and 200 million customers who need someone to take a bet on them and take them through that low and grow journey, right? And I think what makes all our jobs collectively much, much easier now, as opposed to 5 or 10 years ago when some of us began, is that the rails to do this have just eased up significantly, right? Whether it's connectivity, KYC, banking penetration, now account aggregator, et cetera, right? So I think realistically, you're going to end up seeing the market split into 2 ecosystems. I think there will be a quote unquote prime ecosystem, which will see a lot of players trying to serve the 25 to 30 million carded customer base. I think that will be a race to the bottom on fees and pricing. And ultimately, distribution will become the edge there. And so you'll see a few large distribution islands really dominating that game. I think there will be a second ecosystem that I will call the non-prime ecosystem, even though we believe those customers actually can deliver prime loss rates. And that ecosystem is going to be entirely defined by the ability to manage risk, right? Because distribution will become a commodity as all these people have smartphones and will shop here or there. UI UX will also become a commodity because look, we are all good at designing flows and over time figuring out how to cut the number of fields and all that stuff. So it will really come down to the ability to manage risk and grow it, and then eventually be able to attract capital at the right cost to back these risk models and create the right kind of spread and return math to build the profitable financial institutions of the future on these next 100 to 200 million customers, right? And I think it is the second ecosystem that I'm personally a lot more excited about. And I think given that risk is going to be the differentiator there, it's a much longer game than perhaps a lot of the other sort of GMV driven sectors that we see in consumer tech today. And I think taking that perspective of building a business through cycles that's recession proof and priced to actually deliver returns both in a contribution and bottom line perspective, that's going to be what separates the companies that are able to make it over the next 10 to 15 years and not. So pretty excited for that ride. It's not easy. I think in many ways it demands temperaments and muscles that run counter to what is popular and lauded in the tech world these days. But I think that makes it an interesting challenge, right, for all of us. So
Sure, Sashank. Krishnan.
Well, I think the future of BNPL is sound. I mean, I will simply take a consumer lens to it, right? There is a proposition out there, there is a need out there, and there is no product today that serves them. And I think the questions and the concerns and the issues you are laying out will determine whether banks make the bigger push, fintechs make the bigger push. It's some kind of a partnership that goes on for 10 years. I think how the industry will evolve may look different, right? We have some perspective, it could be different. But I think fundamentally, the opportunity is so huge that there is no denying the fact that BNPL is only going to grow. I think I also want to be slightly charitable to the insurance industry. I think the world of today and world of 2001, when the private sector got opened up, is very different. And I do believe, at least in general and health, we've seen tremendous tech innovation, right? And the reach increasing. In life, it's a very unique product. So I won't comment on life as much. So we, at least the 2015 cohort, as Prashanth said, we've been riding a macro wave, which we are all utilizing, right? A macro wave backed by NPCI, building UPI rails, KYC coming up, eKYC, account aggregator coming up. So we are also, all of us collectively are benefiting from a digital ecosystem, which frankly speaking, we are leveraging. I mean, we are also creating new use cases out of it. And, the combination of the two, it'll just grow. It is, to me, a subprime opportunity to now take on what Sashank said. That is where the real opportunity is. And the subprime opportunity is not just tier 2, tier 3. It's the mass market neighborhood. If I talk about Mumbai, there's a difference between Pedder Road and Govandi. There is a huge opportunity across all centers in India, right? And of course, the proportion of such people in the deeper tiers, it's higher, but that opportunity is very, unscaled even in the larger cities like Delhi and Mumbai.
Okay, noted your points, Krishnan. Prashanth?
Look, I'm super bullish, right? I think bite-sized credit delivered to tens of millions who are not your typical traditional urban prime is going to be the way of the future. This is how the market gets expanded. This is how the next 100 million consumers get access to credit. And once they have access to credit and once they build that profile, then other magical things can happen. This is how, by the way, India gets to a $5 trillion economy, right? Otherwise, we don't get there. We don't get there with what we have today. We get there because we are expanding the fringes. And we're expanding the fringes only because, I think what Sashank said, right? We're forced to. We don't have a cost of funds advantage, so we are automatically gonna, we're gonna be like the first voyagers. We're gonna have to find new land. We're gonna have to hunt for new resources. We're gonna have to, sail further than the guys with the big boats, right? So we're going to have to do that as fintechs, and I think that's the beauty of it. And I think BNPL is a phenomenal instrument to kind of create all this and bring all this together. But I'm also a huge believer that, you know, companies that are mono product seldom survive, right? So you have to kind of integrate the BNPL, whether it's a deferred payment BNPL or an EMI checkout BNPL or whatever avatar of BNPL, you have to integrate it into all the lending and potentially other financial needs of the consumer, right? BNPL is a phenomenal starting flywheel. I'm a huge believer that flywheel can yield companies like ours to serve the next 50, 100 million users beyond credit even.
Sure. Let's be that optimistic, Prashanth. And Bipin, your views, please.
Yeah, no, I think I echo everything that's been said. I personally believe that BNPL itself will be bigger than credit card industry. I think we have to give it time. It will be bigger because all the unit economics and the macro factors are in favor. You know, the BNPL industry, or at least the opportunity, is far bigger. And I believe that unless the credit card companies or the banks change their ways, or I mean, potentially credit cards also getting open to BNPL companies, which can do proper cards in some form, either prepaid card or proper credit card. It's a matter of time that, you know, it becomes the norm. I mean, when I think about it, if you're paying online, or if you're generally paying, and if you're a good user, why should you go through the hassle of, you know, so many steps of making a payment? Where something like Buy Now Pay Later offers you the best experience, the smoothest experience possible, online and also offline in physical stores. So I think it will, because it's the only way of also making payments which has really good margins and also has the customer stickiness. So I have no doubt that Buy Now Pay Later will be bigger than the credit card industry overall. It may take 3 years or 5 years or 10 years. I don't know. The second part is also, I think, something that Prashanth mentioned. When we look at the history of banking, which is where it started, right? Have you seen ever any bank succeed which does one product, right? It never really has. If you see all the successful banks, you start with a savings account and then you say, take a credit card, take a home loan, take a personal loan, right? And then, you know, they will sell insurance. And then they want to manage your money. They want to invest. They have the advisor relationship manager who's coming and wants to take your money and put it in the stock market or buy ULIP or something like that. So my point is that in a way, the apps which will have large distribution and which get Buy Now Pay Later customers, and customers get hooked onto it, the fact that the customer comes back on the app every cycle to make a repayment becomes a great opportunity to deepen and broaden the relationship with the customer. And that can be done without people, obviously with the use of technology. And, you know, I think the ecosystem of payments and lending and then savings completes the entire offering for the customer. So I think long term, this is how it will evolve, and different, you know, platforms will obviously have different paths towards getting there. But you know, it won't be a single. Won't be a single product that will succeed. It will have to be these multiple products integrated together and making you know, life very easy for the customer.
Okay, valid points, gentlemen. And obviously, the product has picked up. There are few people have also raised issues on the risk, but I think very important points that you clarified here, and also good to see that all of you are very bullish and optimistic about the BNPL. So let's hope, you know, the rally will continue. Let's hope the people at large will take benefit out of it, and let's hope the fintechs will be successful in this whole area. Thank you so much, Bipin, Krishnan, Sashank, and Prashanth, for sharing meaningful thoughts here at the CIO BFSI Digital Conclave. Thank you so much.